So we're going to start. We're going to have Sharon go ahead and introduce our panelists.
Awesome. Thank you, Mandria. Good afternoon, everyone. This is Sharon Bartlett. I am a realtor with Cito Realty and the Executive Director of Operations at US REO Partners and a task force, default task force member for AREAA. And I'm super excited to be with you this afternoon. As I mentioned to Mandria, we have three awesome speakers today. First, we have Rick Sharga. Rick is the Executive Vice President of Realty Track. Welcome, Rick.
Thank you, Sharon. Nice to be here.
Good, thank you. And then we have Fabian Cesares. I hope I said that right.
Yes.
Fabian is a principal of the California Foreclosure Protection. Welcome, Fabian.
Thank you, Sharon, for having me. Excited
Good
about
to
the
see
event.
you.
Thank you.
And then certainly last but not least, my good friend Larry White. Larry is our self-proclaimed catalyst and creator of opportunity. So welcome, Larry. It's good to see you today.
Man, such a pleasure. Can't wait to see everybody in person here at the 5-star event here in the near future.
I know, I'm
miss
super
all of
excited.
your faces.
Thank you.
We're actually a lot taller in person, Larry.
Yeah.
That's great. So with all of that being said, we're going to get started because we have some really great talking points that I think we could talk forever, but we only have an hour. So I am going to start out. And by the way, I'm Mandria Chetto, and I'm a default committee member myself and been with AREAA for a really long time. I work a lot in the default space, as most people do know and recognize. And I am very, very pleased and happy to be working with Rick, Larry, and Fabian on this. There's some industry leaders and they really have a lot of information to share with us. So without further ado, Rick, I'm going to start with you. Over the next year and the cycle coming forward, what impact do you see in the market as far as things like interest rates, inflation, the foreclosures affecting the market? Should we expect an increase in default activity?
Thank you, Mandarin. Yeah, great to see you.
You as well.
And anybody who's looking for a qualified realtor in Cleveland absolutely needs to be working with Mandria. So you ask a couple broad questions, interest rates, inflation, inventory, foreclosures. Let me start with foreclosures and kind of work my way back real quickly. We're coming out of a cycle where there's virtually no foreclosure activity. Even before the pandemic, before the foreclosure moratorium, foreclosure activity was at historically low levels. Normally, we see about 1% of loans go into foreclosure in a given year. Prior to the pandemic, it was about 0.5%. So we were running at 50% of normal levels. And that slowed down to almost nothing because of the foreclosure moratorium. It's very likely that now that the moratorium is over and the CFPB has allowed certain carve-outs that servicers can move forward on foreclosures, we're likely to see a bit of a blip in the fall because there were about 250,000 loans that were in foreclosure prior to the moratorium. And the CFPB has basically said it's fair game for mortgage servicers to restart those foreclosure proceedings. So there could be 250,000 properties that were in some stage of foreclosure that all of a sudden get put back into the pipeline. That'll vary state to state. There are some state laws that may come into effect here that give a servicer a certain amount of time to execute a foreclosure. We may have exceeded those timelines because of the moratorium. Whether there'll be a waiver that allows that to be ignored or not, we don't know yet. But there's likely to be an increased level of activity, and we're likely to see a continuing increase in activity over the course of 2021. I see two other small waves of foreclosure increases hitting in 2022. One is probably shortly after the first of the year when the CFPB's rules expire and when the usual holiday moratoria that are put in place by Fannie, Freddie, and FHA are lifted. So we'll probably see a little bit of foreclosure activity increased in sometime in January, February. And then probably about halfway through next year, when the majority of people have finally exited the mortgage forbearance program, and servicers have had a chance to work with those borrowers to see how many of them qualify for either deferrals or loan modification programs. What we will not see, and I'm willing to take a dollar bet with anybody who's attending today, but what we will not see is, millions of properties going into foreclosure like we saw back during the Great Recession. We can talk about this in more detail as we go through today's webinar, but market conditions are completely different than they were 10 years ago. Homeowners have a record amount of equity, over $23 trillion in equity. 75% of homeowners have more than 20% equity. 91% of the homeowners in forbearance have more than 10% equity. So borrowers who do find themselves in financial trouble are going to have options to be able to sell their home at a profit and walk away with some cash in their pocket. The two things that could, that you mentioned that could slow down demand pretty significantly are inflation and interest rates. And I tie those two together pretty dramatically. Wages have gone up 4% over the last year. Inflation is currently running at 5%. So people are making more money, but it feels like they have less, and that's because everything costs more. Chairman Powell from the Fed and the Biden administration are encouraging us to believe the inflation is transitory. The definition of transitory, I believe, means they're not sure what's going on, but they hope to figure something else out in the meantime, so stand by.
Yeah.
But if inflation becomes a long-term issue, it will have an impact on interest rates. It will have an impact on what people have in terms of disposable income and how much they can spend on housing. So inflation is something to watch for. It's almost inevitable that with the government injecting $7 trillion into the economy, we're going to have some inflation. How much they can control it is a big question. And when we've had inflation in the past, one of the things the Federal Reserve has almost always done is overreacted to the inflation and caused a recession. So that's something else to watch out for. If interest rates do go up, affordability will go down. That could definitely dry up demand to a certain extent. Shouldn't dry up things to the extent where we see the market go into a deep correction and prices fall off a cliff. So in short order, we probably will see interest rates go up a little bit, even if inflation is under control. That will impact affordability and slow down demand. Inflation is likely to be a problem, at least in the short term, if not in the longer term. And we are not going to see a huge wave of foreclosure activity, but we will see increased levels now that the moratorium is over.
So, and Rick, because you're Rick Sharga with Realty Track, not that you have a magic crystal ball, but what do you see as far as these increases in the interest rates? Not that we're going to hold you to it, but we might. You're usually right about these things. But timelines, do you think this is going to be in 2022, 2023?
I will, full disclosure here, Mandria, I have been predicting interest rate increases, I think, incorrectly now for about 8 years. I'm starting to feel like that broken clock on the wall that eventually I have to be right at least twice a day. I don't think we're going to see increased interest rates this year. I would be surprised if we don't see a marginal increase in interest rates in 2022, even if inflation is kept under control. I think there's enough downward pressure on interest rates from what's going on in the global economy, and there's enough knowledge in the mortgage industry that if we suddenly increase interest rates by 1.5 and we go from 2.5 to 4%, it's going to have a calamitous effect on lending. So I don't think we're going to see a huge increase, but I do think we're starting to see yields on the 10-year Treasury bonds go up, and typically interest rates go up along with them on the 30-year fixed rate loan. So I wouldn't be surprised if over the course of the next 18 months, we saw interest rates go up by a point or so, and do so in small increments. But that's kind of what I'm looking at, and that seems to be sort of the midpoint in the predictions I'm seeing from Fannie Mae and Freddie Mac and the Federal Reserve and the Mortgage Bankers Association. So if you look at those kind of sources, I don't think a point increase over the next 18 months would be unusual.
And one more question before we move on to Larry here. Do you believe, or are you seeing, I believe I am, judging by what we're reading from the CFPB, and that the government is going to step in with these moratoriums and try to do the responsible thing to keep the market from completely crashing. And the Fed is going to try to hold that back because, essentially if Q2 of 2022, the interest rates skyrocket to balance inflation, that would be devastating to not only the real estate market, but the economy. But do you see a big push for this to happen? Do you believe that they're really going to support us in this?
So let me use a little bit of historical context and just use recent history. The CARES Act that was initiated back in, I believe, late February, early March of 2020. Probably the most successful example I've ever seen of the government and the mortgage industry working together in the 20 plus years I've been in the industry. And it was an unprecedented action from the government to step in and try and prevent unnecessary foreclosures. And my definition in this case of an unnecessary foreclosure is a foreclosure that never would have happened except that somebody's finances were impacted by the pandemic. And we have saved literally millions of people from foreclosure over the last 18 months. Just an incredibly successful program that isn't over yet. And all indications, we've had over 8 million people in the forbearance program. We're down to 1.5, 1.6 million now. As 6.5 million people have exited, our delinquency rates have gone down. So not only are they exiting successfully, they're not going back into default or delinquency after they leave. So just remarkable, remarkable program. The moratorium did what it was supposed to do. The CFPB was surprisingly reasonable in the rules that they implemented that servicers need to follow for the next 6 months or until we get through the balance of 2021. So everything we've seen from the government, whether it was the Trump administration, the Biden administration, the CFPB, has been remarkably consistent and remarkably well thought out. And then not so remarkably successful. So do I expect that the same people responsible for those programs would let the economy crash and burn? No, I don't. I don't know if the Fed will have to be careful in managing inflation, because the usual way they manage inflation is to raise the Fed funds rate, to make borrowing more expensive and to slow things down a little bit. I think one of the things that will happen that will help with inflation, and this is going to sound counterintuitive, so bear with me, is the government stimulus programs that have included enhanced unemployment benefits are due to expire next month. Right now, there are more jobs available than there are people on unemployment, which almost never happens. What that means is employers are fighting over available employees. And that's what has caused wages to go up by 4% year over year. So the cost of labor is one of the things that's driving inflation. When those enhanced unemployment benefits go away, I believe you're going to see a huge uptick in the number of jobs being filled by people who candidly were making more money sitting at home collecting unemployment than they would be going back to work. That will drive labor costs or slow labor cost increases down a bit, which should help on the inflationary front. The other thing that will prevent, I believe, the economy from tanking is the infrastructure bill that was just passed. Assuming nothing happens to slow down the execution of that, there's another $1 trillion being injected into the economy that will also result in many, many jobs being created. So those two factors, and those factors really won't start to be felt until next year because it takes a while for those jobs, should help keep the economy from tanking. I know that was a long answer, but it's a complicated question.
It's an interesting, it's very insightful, and we really do appreciate it. And you are a data guy, so we expect to, thank you. I appreciate it. And Mr. Larry White.
Yes.
You join us with all this experience all over the place, but a little bit, I'm looking more a little bit to the agent, your opinion. So you have background in foreclosure, real estate, all of it. So
Yeah.
we know you work in a lot of spaces, which is why I have a little bit of a long-winded question for you as well,
Okay.
questions. And I'm kind of curious what the housing supply is like in your market.
Sure.
And I'm also, Sharon, when Sharon and I were kind of talking through doing this particular session, we were talking about different things. We are the default committee. We specialize in all things foreclosures and servicing and things like that. But with the decrease in the housing supply that we've seen, we're starting to see more things like appraisal, drive-by appraisals, the appraisal gap coverage, overvaluing. Could that in any way, in your market, are you seeing an uptick in supply to begin with? And what's your take on that?
Yeah, absolutely. And so, I've had the opportunity to kind of have this mile high look with different companies that I've ran and the relationships and helping, find the right agents for a lot of the clients and stuff that I consult and I work for across the country. And there is still an overwhelming lack of inventory across the country. Right? On average, like in a normal or a healthy market, we generally see about a 6-month supply of inventory, give or take. And in most markets, we are still less than a 2-month supply of inventory, which is creating this seller's market, which is continuing this increase in pricing. And so, there's a lot of variables and stuff that I look at. Interest rates being one of them, right? Right now, they are very low. So that allows people to be able to buy that higher price point home. If we start to see a fluctuation in those interest rates, that could start playing with our amount of supply because people cannot afford the same amount of home. Right now, it's okay because they can buy that bigger home and still have, meet their debt to income ratios and things like that. If those start to increase, that's going to limit and drive more of the everyday home buyer down into a very competitive market. So I think that you could see kind of a shift there. And, maybe above a certain price point, start to really increase the amount of supply just due to the lack of buyers. And then below a certain price point becomes even more competitive than it is today. So inventory is still a real situation. I don't know of any market that I'm looking at that has more than 3 months supply of inventory at this point in time. So it's still a very heavy seller's market. And that's where you're continuing to see these very steep and I would say appreciation rates that are not sustainable over long term at this point. And I was as I was listening to my good friend Rick there, and if you don't mind, like I just wanted to just kind of have a little conversation because I think this would really help like our panel or our audience that's here today. So Rick, like last time I looked, I think was in April or maybe even May. There was about 2.3 million homes like in the forbearance process, right? Which does not account for our default ratio, right? Like those are not being tracked as, homes that are in default because they have this workout program and stuff there. What I'm curious about on this is because we haven't foreclosed on homes in 2 years. So even if we just took that 0.5% to 1%, right, we're starting to build this supply. Now, I totally agree that people have options that they didn't have before. But even last time when people had options, sometimes it was kind of that ostrich effect where people would stick their head in the sand and just be like, look, I really hope this goes away. Maybe they'll forget about me, right? Because it's an uncomfortable situation. And as real estate professionals, this is where we provide value to our clients. Right. The more options that we can provide to people, the more options, how we can help guide them because it's not about what's best for you or me or anybody else. It's what's best for that family in their particular scenario. And the more we can educate them, the more value that we add. So I guess my question back to Rick is, out of those 2.2 million, even though they have options, right? Even if we start taking small percentages of 2.2 million homes, does that like add to the supply? Do you see that increasing kind of the default ratio? Because that's kind of my logical thought process. But again, you're the numbers guy, right? Like you see all of the data that backs this up. So I'm always curious, and we converse a lot. So what are your thoughts on that, Rick?
Yeah, it's a great question, Larry. It's a very valid question. And I think after I answer, we can pivot over to Fabian real quickly, because what he does for a living is deal with a lot of those distressed homeowners who have their head stuck in the sand, or hiding somewhere in fear of losing their home. And he has programs to help them out. I do think realtors can play a really important role. I'll get to that in 1 second. Just to show you how quickly things change. That 2.2 number was probably 2.2 million number was probably correct back in the spring. We're down now to about 1.6 million people in forbearance.
Okay.
And about half of them are scheduled to exit forbearance between now and the end of the year.
Okay.
And the ones who have been exiting 86% of the time with either a plan in place or have simply had their loans reinstated. And in fact, a quarter of them continue to make payments. They've never missed a payment, even though they've been in forbearance for however long they've been in forbearance. So those people are exiting very, very successfully. Do I believe that a certain percentage of those people will ultimately wind up in default? Will they be most vulnerable to default? Yes, I do. I don't believe it's going to be a very large number, relatively speaking.
Sure.
If we're looking for areas of vulnerability, I would suggest there are two to look at. One is the FHA loan portfolio. So the FHA accounts for about 15% of all mortgages. About 10% of those loans are seriously delinquent. So 15% or 10% of 15% works out to somewhere in the neighborhood of 700 to 750,000 loans that are probably the most vulnerable to going into default. That's a lot of loans. In the overall scheme of things nationally, with 50 million active loans, it's not a huge number. It won't be enough to change the dynamics in the entire marketplace. But if you're in a market that has a high percentage of FHA loans and a high percentage of those loans are delinquent, that could have an effect on what it feels like in your market. So if you're in Atlanta, if you're in San Antonio, if you're in Houston, Dallas, Fort Worth, if you're in San Bernardino or Riverside, if you're in Philadelphia, if you're in Tampa or Orlando, those kind of markets, those markets with high concentrations of FHA borrowers, FHA borrowers tend to have less equity. They tend to have less cash reserves. They tend to make less income. They tend to have higher debt loads. If they get into trouble, they're going to find themselves having a hard time getting out. And what I've been telling agents, and this is a hard thing for agents who are used to REO listings to kind of get their head around, something you can probably help them with, Larry, is this cycle is going to be very different than the last cycle. Last cycle, a third of homeowners were underwater on their mortgage. They didn't have an option that let them escape a foreclosure. The lenders repossessed almost all the properties that went through foreclosure. Nothing was selling at the auctions. Lenders had to take all these properties back and agents would get REO listings. I really believe that this time, the majority of homes that go into foreclosure, get that initial notice, are going to be sold before the auction ever takes place.
Yeah.
And that's where realtors can really execute a win-win situation where they can get themselves a sale, but they can also save a homeowner from going through an unnecessary foreclosure.
Yeah.
I believe a lot of the loans, a lot of the properties that don't sell in pre-foreclosure at that early stage will sell at the auction. And there's only going to be a smattering that go back to the banks. But companies like Fabian's have programs in place that agents need to know about that can help those distressed homeowners who, to your point, Larry, will get that first foreclosure notice. Make sure they don't wind up becoming an unnecessary foreclosure statistic at the end of the day.
Yeah. Yeah, I appreciate that insight and stuff there, Rick, and hopefully that kind of helps all of our audience and stuff as well. Mandria, you had also kind of brought up, the appraisal gap, the coverage and stuff, right? Because naturally we've seen this in other cycles as we've had this rapid appreciation is, we're having, appraisal issues come up. There's people that are waiving the appraisal addendums. It's not necessarily something that I generally recommend,
Right.
at the end of the day. But people are doing that because of the lack of inventory and stuff that's out there. And so, I think that we will start to see, it's all a supply and demand curve for that I look at. And right now it's still in the favor of the seller and stuff here, but there's a lot of unknowns out there with interest rates, with our stock market that really has been, in this upward trend for the last 12 years now.
Right.
And really hit this hockey stick. I mean, I remember when we used to talk about like $20,000, like being the ceiling, and now that's not even close to the floor. Right. And so there's a lot of things there as the moratorium ends, as our stock market, as we're continuing to pump money in, and some of these companies are not showing the returns and the revenue and stuff that are seeing this. If we start to see dips there, it could translate over to the housing market because people may not have, as much liquidity and stuff as they thought because their money there is changing. And so there's so many variables that we kind of have to look at. And again, as real estate professionals, the more we are directly compensated by how much value that we add to people right now. So there is a huge niche. There's a huge opportunity for agents to be familiar with companies like Fabian's and programs that are out there to be able to help people, and coming at it as a resource perspective, coming at it as this is how I can help educate the public and be of value, not just to one person, but to communities. And I'm big and bullish on video, and there's a huge opportunity to educate a lot of people very quickly in these particular markets, if that helps.
Yeah, it does. And before we move on to Fabian, who has some really interesting resources and things that will help us in our business as well. I guess the bottom line, I'm sure everybody's wondering this, and of course, again, it's an opinion. I'm not going to use the word housing bubble, but do you believe that, long story short, do you think real estate is going to continue upward trend and level out, or do you think there will be a decline in value?
So, oh gosh.
Hey, this is the big question, right?
Yeah. So here's the thing, right? Like, in whatever market cycle that we went in, I'm constantly looking at what's next, right? And around 2014, like my group started working very heavily with hedge funds because prices were at all-time low, rental rates were going up. That was the opportunity, right? We have not foreclosed on homes in the last 2 years at this point in time. But like a lot of my groups across the country are still taking foreclosures. It's just not the Fannie, the Freddie portfolios. It's private investors that are loaning money to investors that are buying these wholesale properties because they received this email that says, hey, buy this home for $250. Its ARV is $400,000, and people are buying it without doing their diligence. And they're buying a home that's worth $325,000, but it needs $70,000 into it, right? So there's homes that are still foreclosing at this point. There's still opportunities in the default space as we sit right now. And I do think that there will be an uptick in default properties. I don't think it will cause a crash at this point. But again, there's a lot that goes into that with, with our employment rates, with our job market, with our stock market, and where people are holding their money and stuff right now. And some of those things could either add or detract from that. So, after every up market, at some point the market has to flatten out because we'll outprice people, and they're like, that will tell us, hey, prices are too high. It will have to come back down to be able to order to sell. I don't see that happening in the very near future because of the lack of inventory right now. But I do want to have my relationships, my groups and teams positioned with the foreclosures that come through, because they're selling very fast, they're selling at very high volume. So even though I think there will be less, there will still be a lot of opportunities. And it may not be the same market that we used to be in, where I was selling $9,000 and $12,000 foreclosed homes.
Right.
I think we've appreciated past that at this point, but I do think that there will be opportunities for those that add value to banks, to clients, to different institutions.
Mandria, can I jump in there on the bubble question real
Absolutely,
quick?
yes.
Realty Track, we don't believe we're in a bubble. We can't keep having 18% year-over-year price increases and not get to a bubble eventually, because wages can't go up 4% and home prices go up 18%. The math just doesn't work in the long run. One of the things you have to keep in mind is that the price increase numbers we're seeing have a little bit of static in them. They're not pure and clean numbers. Two reasons for that. One is that there's what we would call a product mix in what's being sold. There's virtually nothing available for entry-level buyers today.
Mhm.
So we're seeing the median price continue to go up because people are buying more expensive houses. And they're buying more expensive houses because there's nothing cheaper on the market. So first-time home buyers in the most recent NAR report only accounted for 30% of sales. Normally, they're between 35 and 40%. So the mix of products is a little skewed toward more expensive properties, which makes the data look higher when it comes to prices than it actually is. The other thing you have to keep in mind is that since first-time home buyers are a little less than 30% of overall sales, that means 70% of people buying a house are repeat buyers. Why is that important? It's important because they're now trading the equity that they just gained because their property went up 20% in value year over year. And they're using that equity as leverage to buy their next house. So this is not 2008, where a first-time buyer with no money in the bank was getting 100% down or a 0% down, 100% mortgage on an overpriced property. This is somebody putting 20, 30, 40, 50% down on that more expensive house because they had acquired and accumulated all that equity in the prior house. So prices are going up because of supply and demand, because of low interest rates, as Larry mentioned, and because of the mix of properties and the amount of money that people are able to put as down payments on the new purchases. That's not what you see in a bubble. Having said that, as I said, we can't keep having the prices go up the way they're going up without getting into bubble territory. And I do believe we will see market corrections in some markets. You take a look at coastal California, you take a look at the Pacific Northwest, you take a look at markets like Austin, Texas, where home prices have just been escalating extraordinarily. And we will hit an affordability wall, particularly as interest rates go up. And I would not be surprised to see a 5 to 10% price decrease at the higher levels of those markets. So home prices don't always go up. They go down sometimes too, but over the long run, historically speaking, they've always wound up going back up.
Another really good point on that, Rick, from what I'm seeing, is you're having some of these places that are running up against this home affordability, as the Pacific Northwest, California, you're seeing an exodus from some of those, right? Which is driving increased prices, in this Texas triangle between, Dallas, Houston, Austin, San Antonio, et cetera, right? A lot of these, you're having people put 50, 60% down because they're moving their equity from these high prices of California and moving to someplace where they can get more home, more money, more land, et cetera. And again, so you might have these little market corrections in particular markets specifically as well.
Do any of you know what the city with the highest year over year increase in home prices is in the last year?
Phoenix.
What?
Phoenix.
Phoenix is in the top 5.
Yeah.
Probably Austin.
Not Austin.
No.
I would say
What?
Denver area.
Denver is high. It's Boise, Idaho.
Whoa, yeah, Coeur d'Alene.
45% year over year increase. Salt Lake City is in the top 5. So Larry's right. People are moving from higher price states to lower price states where they're getting more house. Median home price in California right now is $800,000,
Wow.
which means neither of my kids will ever be able to buy a house in California.
Yeah.
And honestly, my adult son is already talking, he and his girlfriend are talking about where they're going to move when they have to buy a house. So it's just the real world settling in. It's a great point, Larry.
Mhm.
It is a good
Absolutely.
point. So with that being said, and it's a great conversation, I appreciate your insight. I think a lot of people are thinking these same things and just want to hear it from some experts too. Now, with all of that being said, what do you do business-wise? Where do we go next? How can we help to service our customers and clients, especially people who are experienced in the default space, the REO space, and the servicers? What can we do? What conversations should we be having? Because we have the opportunity now, like Larry and Rick have both indicated, to avoid the foreclosure altogether. So that's why we have one, because we like him, but also because he's really smart about this stuff and has some resources. Fabian, we want to talk to you a little bit, as we're coming out of the foreclosure and eviction moratoriums, do you see the opportunities for agents to be working with the bank servicers and clients? How do we identify these? What types of programs are out there that are available, and what resources do we have to work with?
So absolutely, there's an immense amount of opportunity out there, and I've been exercising that opportunity for years. COVID came in and brought a certain circumstance to the marketplace that kind of caught many individuals off guard. Our organizations and the organizations that we worked with had already been dealing with this in a different space, meaning that we were involved in making home affordable, doing the modifications, doing everything for free. We were an underwriter to the organizations that I was part of. Keep Your Home California. These were all these different programs that were giving all of this different service to families for homeowner retention options, prior to COVID. COVID just brought everything to a different level now, because you had all these families now elect to go into forbearance, and many of them didn't necessarily have to, but many of them did. So there is an immense amount of opportunity prior to COVID, and even during COVID and post-COVID. Because you're having a number of individuals right now, as Rick said in the statistics, every month you're having hundreds of thousands of families, homeowners, that are exiting forbearances. And if you look at the months, every month's going up on the number of exits. But what you have to see, that 86% of the forbearances were on an extension, meaning that many of them had to stay in that forbearance because either they had no workout solution available to them at that juncture, they were unemployed, or they were just taking advantage of this, of the program. As you well know, that the forbearance program doesn't end to August of 22. Although the applications will stop next month, the 18-month trial period, these are Freddie and Fannie, will go up to August of next year. So many families have been exercising that option. Unfortunately, the problem that I see moving forward is that many of them don't understand the ramifications post forbearance, because many of them, what you're going to see is that they're going to exit their forbearance, but when they exit their forbearance, they're probably going to, if they're Freddie or Fannie, they're going to go into a payment deferment. If they're HUD, they're going to go into the COVID recovery standalone partial claim, which is like a payment deferment, which basically they're just going to add everything to a silent second. It's payable upon refinance, upon sale, or the maturity of the loan. There's not a whole lot of documentation you need for Freddie or for Fannie to go ahead and receive the payment deferment. The problem is that we're finding that 3 to 6 months later, they're going back into an extension because they're still in a hardship situation. So what we find is that many individuals, from what we see on a day-to-day basis, is the lack of information. A lot of consumers don't really understand what comes after forbearance, what options are available. If you're Freddie or Fannie, if you're HUD, which encumbers FHA, VA, USDA, and Ginnie Mae, there's a certain program, that's the waterfall program, which they just revamped. And then under Freddie and Fannie, you got the payment deferment, the extend mod, extend cap mod, the cap mod, and then the flex mod, which is the most comparable. That's a 40-year modification, and it's designed to give you roughly anywhere between about a 20 to 30% payment reduction. That's the goal behind it. Those are great programs, but many families don't really know what they entail, and they don't really know where to turn to get that type of information. So what they do is they go to their realtor, or they go to their lender. Now, most realtors and lenders don't really are equipped with that kind of information. I mean, let's just be honest, that's not what they do.
Right.
So what we find is that for the consumers that have already exited default or will soon exit default, and they don't have an exit strategy, they go to an agent and they'll say, Mr. Agent, this is my situation. What can I do? Well, as an agent will do as well, sell your home before they take it. I mean, and that it's the nature of the beast. A lender, well, let's try to do a refi. Let's try to do a reverse mortgage, excuse me, if you're over 62. They'll do the normal pitches, if you will. But unfortunately, for many of these families, they're not going to qualify for a lot of those programs. And many of those families aren't ready for that. Many of the families aren't ready to come to the realization that they may have to sell their home. They're still, the government let me stay here for the last 16 months, 12 months, 10 months, whatever. I'm sure there's going to be something after the fact that I'm going to be able to stay in my home.
And that's a really important piece, because a lot of, Larry had mentioned, a lot of people, the ostrich thing doesn't work. And a lot of people, when we come to them and say, we can save you from foreclosure if we do this, this, and this, and they say, well, I want to stay in my home.
Correct.
And once you've exhausted the waterfall, this resource, this resource, that may be your only option. And I do think it's important for agents to be educated and know this, because it's not going to be where it's like, I want listings, I'm going to register with this company and they're going to give me listings. Correct. You have to be able to add that value.
Correct. And that's where we come into play. We're advocates. I work with nonprofits. I'm an employee of nonprofits, and I've been doing this since 2006, engaged with nonprofits. And throughout the years, what we've done is we provided every single home retention service available for free. We do not charge a dime to the consumers. Consumers don't need to go to attorneys unless they want to file a BK or they want to litigate, and that's their choice, which really the outcome is never, or very limited, the outcome that they're looking for. They can go to modification companies, they can go to scam companies, that is their choice. Unfortunately, we find that probably, I'm not going to give a percentage because I couldn't give a percentage. I'm going to say a high number of individuals that come to us have already exhausted that particular area of going to attorney and paying thousands of dollars for basically nothing, because at the end of the day, it's up to the bank or the courts to provide them with a workout solution. And the modification companies that basically just putting a modification package together and submitting it and charging them thousands of dollars. When they finally realize that that doesn't work, then they come to us. The benefit in part to us is that HUD, servicers, Freddie Mac and Fannie Mae, when a consumer today calls and they ask for some assistance, they tell them now to go to their websites and find a local nonprofit. Go speak to a local nonprofit. They provide free services. They can help you with your modification packages and forbearances. And that's how they contact us in part. And what we do is we evaluate them as to what their current situation is. We never, ever approach a consumer with the intention of selling their home, ever. Our intention from day one as an advocate of home ownership is, how do we help you stay in your home? And either be it through our counseling, through our HUD counselors, for our financial literacy, our credit counseling, within the financial literacy, we have our budgeting. We go through all of these different steps with them. And we even submit their modification packet for them. Again, all of these services are free. In the event that they get the workout solution, then I just say, good luck to you, God bless you, good for you, move on. And I hope you can sustain that now, because it's not only getting a modification. Are you going to be able to sustain whatever they gave you in the long run? And that's one of the big issues too. Many families will take a modification based on three things: fear, impulse, and lack of information. This is why we see many families within the first 9 to 12 months default, because after the fear, impulse is gone and they start to realize, well, hold on, I'm paying on a home that may not even be worth what I owe on it, because now they deferred everything I owe on it. So I'm basically paying on a non-performing asset. Now, grant you right now, our market may be a little bit different because of the appreciation. But a couple of years back, I had families paying on homes that were probably worth $450, $475, and they owed $650. I'll give you an example. I got a client today. He owes $800,000 on the property. It's only worth $675. So, where's that logic to keep the home? The ability is that we can do the short sale for him. He could walk away. He could buy a home at a later date. But once we did the numbers, once we sat with him and showed him the numbers, he had a whole different realization as to where he was at. He never thought about it as a non-performing asset, because nobody ever talked to him in that fashion. The only thing they were telling him, we'll mod you, we'll do this and we'll do that, and we'll throw everything in the back of the loan, or we'll go litigate, or we'll file a bankruptcy, and we'll try to discharge the second. That's a bunch of hoopla, because at the end of the day, they're still going to be responsible for a certain amount, regardless of what happens. And I tell them at the end of the day, you're basically just an absentee renter. That's all you are. You're renting your own home because there is no equity there. Now, as going back to where's the opportunity for the agents and the lenders is, I call it home ownership advocacy. Basically talking to the consumer and saying, how can we partner and how can we help you save your home? We can go through all these steps. The agent doesn't necessarily have to do anything other than the initial contact. Then what they do, they either send them, if they're local, they can send them to organizations like ours. We do everything, as I said, we do everything for free. In the event that they don't qualify for any workout solution, it goes back to the agent. And now the agent can go back and either sell their home, refinance, or do a reverse mortgage, or whatever they decide to do. Our job is just to help them stay in their home. And at the end of the day, if either their mortgage company doesn't give them a workout solution, or the courts didn't give them anything that made sense to them, and they have to sell, well, that's the opportunity for the lender. That's the opportunity for the realtor. When we go in, we go through all of this. At the end of the day, when they're denied, then what we do is we tell them we also provide foreclosure prevention options. Those foreclosure prevention options are, we can either sell your home as a standard sale, or if we need to, as a short sale. If it's a standard sale, what we do is we do, and this is not for everybody, this is just for us, we do a 4% commission. Because one of our program benefits is that we know that as they're transitioning out of that home, because they have to sell now, they need every dollar to do that transition. Mm-hmm. So by us charging them a 4% commission, if it's two agents, or it can be 3% if we double end it. And in this market, that's pretty good, because there's a lot of properties out there, you're not getting full commissions anyways, but we're getting the listing. Plus, the benefit to them as well is that they've already worked with us. They see us as a trusted, credible entity, because we never went in initially to try to sell their home. We went in to try to save their home. We know what their timelines are. We know what their financial hardship is. We've already communicated with their servicer, lender, whomever it is. We know exactly what their whole scenario consists of. So moving forward, who else would they use?
Right. And chances are, if they didn't employ the ostrich method and we could catch them early on, which there are ways to identify these types of borrowers, then there probably is a workout solution available. And as we know, a lot of these workout solutions from Fannie Mae, Freddie Mac, HUD, they haven't quite been implemented as of yet, but we do believe that they're going to have more resources available. So
correct. Well, they're saying that the modification process is going to be much more streamlined. There's going to be fewer documentation. When you do the payment deferment, there's no documentation. Basically, you're going in, you're ascertaining, saying that you're ready to go, and boom, you're in a payment deferment. Now, when you get a FHA, you start doing the partial claim and you start doing the different waterfall methods. That's a different story. There will be documentation. As such, you'll have the modification program. If you don't qualify for the standalone, the standalone partial claim, there will be documentation for the COVID-19 Recovery Modification Program. So there is documentation. But again, the key element is this, and this is where I think a big disconnect's at. The consumer has to show that they have the ability to repay and have a payment that they can make every month. And that's where individuals don't get. I get a number of individuals that call up our organization on a daily basis asking for a modification. They don't even have a job. Yeah. They think that because they can come right out of the forbearance, that they can go right into a modification. I said, no, that's not the way it is. You have to qualify if it's not a payment deferment or a partial claim. The other area that we're seeing a huge increase is pre-COVID. Any borrower that was in default before January 29th, because COVID went retroactive a month. So they said anything before January 28th of 2020, they're not going to qualify for these programs that were created for COVID hardships. those are the ones right now that we're working with because the notice of defaults have already been reported. Those are the properties that are, when that moratorium lifts, those are the ones, if those homeowners, borrowers do not take action immediately, those are the properties that you'll see, like Rick said, you'll get a first little wave to go through. I don't see that. I see that first wave as many of the individuals that were pre-COVID, that
Yes.
were already in default and took advantage of COVID. I'll give you an example. Our organization, February the 1st, we had 9 short sales in our pipeline. Come March 31st, we had 0. They all canceled and they all went to forbearance. Well, guess what? They're all calling us back now saying, hey, we're ready, because they got their notice that their forbearance now is about to expire next month. So 30 days prior to the expiration of a forbearance, the borrower homeowner is going to get that letter saying your forbearance expiring. You got to now engage for some type of workout solution. And that's what we'll either go with the payment deferment, the flex modification, the waterfall, the partial claims, whatever the case may be. But you got to remember that doesn't entail for hard money, private money, portfolio money, if it's not backed by the GSE or not GSE. So no, that now you're dealing with a whole different arena of regulations and programs and policies and interaction. The big one that I was talking to you about earlier, the one that we're getting a number of calls on, is the HELOCs. Those HELOC loans that these consumers haven't made in years, they're knocking at the door now, and they will not modify. Their payment arrangement is double to triple the original loan amount for anywhere for 3 to 5 years. You know, these homeowners aren't going to be able to pay that. So these are the type of homeowners that really need to get educated. And the other area is just all the scams that are out there. There are so many scams out there right now that families have to really, really watch who they're dealing with. You know, there's companies out there, and I won't say the name out of respect for the companies, but, you know, they're charging a $500 forbearance application or modification application. So they're trying to get these agents to join their systems, and then you pay $500 and then they give you a modification packet or a forbearance packet. Well, guess what? The consumer can call their bank and get that for free. And number one, you don't need a forbearance packet. You just call and ask for a forbearance. You don't need anything. On the modification, you do. So these are all the different things that consumers need to know, but also the agents need to know, because there is a lot of opportunity out there. There are going to be properties out there that are going to need to be sold. And because of the equity, just like Rick said, you know, you have 96% of those ones that exit had to have 10+% equity in them. So they could at bare minimum walk out with a few bucks in the pocket, not have a foreclosure, walk away from the house with dignity. You know, they may have to rent for a couple of years, but then they're back in the game. But you're going to have those that are going to wait to the last minute, because I get those calls every day and think that we have a magic wand that's going to go poof, and then we could stop it, and we can't. You know, we can't. Yeah, you can go file the bankruptcy, but that's only going to give you 30, 60, 90 days. And after that, you're back to square one, and you're paying thousands of dollars. You know, again, to each their own. You can do what you like. But I think the key element is education, partnerships, and really understanding, you know, what it entails for home retention, and agents, the ones that are on the line, on the chat right now. Work with your local nonprofits. They will communicate with your clients. They will counsel your clients, and it's free. These services are free. At the end of the day, you as the agent can look at the hero, because you're actually standing beside your client, not in front or behind them, or trying to take, again, I hate to use the phrase, but, you know, trying to persuade them to sell before they exercise any options to retain their home. And this is where the opportunities come. You know, we do absolutely no marketing, zero marketing. The phone rings for us, because in everything we do, it's advocacy. We're here to help. And when you got HUD, Freddie Mac, Fannie Mae, the service are sending you consumers, I mean, it speaks for itself on the legitimacy. Now, again, they're not sending them to me; they're sending them to the HUD agencies. So that goes up nationwide, and I'm just a byproduct of it, because I'm the one that will speak to them and assist them. So, as I mentioned, there's a lot of families that need your help. You know, sometimes we have to give back as an industry. This is the time that we have to start giving back as an industry. But there are benefits to it, because I assure you, this is what I do every day, and I get business. Now, the thing about these type of deals, though, many of them are not today deals. it may take you 3 months, 6 months, 9 months before that deal comes to fruition, because during that timeline, they're working out, trying to get a mod, they're working out, trying to do whatever the case may be. But would you rather work with a client today that you know that well, I'm not going to say, the probabilities are that 3 to 6 months, they're going to come back and say, hey, Mr. Realtor, there wasn't a workout solution. We're ready to sell, list our property. So this is where we come. Go ahead.
I was just going to say, I want to just jump in real quick with just a friendly reminder to realtors. So I know most of our listing agreements do ask the homeowner if they're in default on their loan. And they may honestly answer it and say no, that they're not, because they have a modification or something, and they haven't disclosed that to you. That's something you need to ask and talk to your even retail clients, especially right now, because many of these do have something that's on the back end and they're not thinking about that. So when they get to closing, they're finding out, oh, wait a minute, I'm not going to get what I thought I was going to get for selling my house, because I have this additional loan on the back end from whatever was moved to the back. So definitely something that realtors need to be talking with their clients about, even on retail sales.
Yeah. What I do as a general practice is when I pull that property profile, I go through the search. I just go through everything and I ask. But you got to remember that there are times, and actually more times than not, that they do not record modifications. You'll receive it in the payoff. You'll see the outstanding amount in the payoff, but there's no documentation recorded for that modification. So you can't only assume because it didn't show up on title, the chain of title, that they don't owe. That's the question that I pose just by general practice now. Have you ever been in default? Do you have a modification? Just all the questions that we go through, because you're right, we don't want any surprises at the end. And the seller doesn't want any surprises at the end, because when you see that net sheet for what you provided them from day one, and then you see the closing, the final HUD, and then now it's thousands of dollars difference, they're going to say, well, whoa, what's going on here? Well, it's the demand that came in. And that does happen because, we've had individuals that did record notes prior to closing that we weren't aware of. And this is where you have to pose that question to the seller. Is there anything outstanding out there that may affect? Because that can take you to a traditional retail sale to a short sale just for a matter of a few $1,000s. And it's happened.
The homeowner could change their mind too at that point. If they know that they've got that to deal with, they may determine it's not in their best interest to sell right now at all. If they can afford to stay in the house. So just conversations to have that we wouldn't have normally had, but based on our current circumstances and the arrangements that have been made due to COVID, these are things that we really need to be talking to our clients about up front.
Correct. And if I just close with this, we designed a number of websites and funnels that I utilize on a day-to-day basis. And I tell the agents, you're more than welcome to go take a look, get information, send your clients. There is absolutely no solicitation on anything that we provide. You will not see realtor, lender, sell your home. Absolutely zero. It is just information for agents and consumers to go to. What are the benefits of modifications? What are the pros and cons? Who qualifies? Who doesn't? What's this? What's payment deferment? Everything that CFPB, HFFA, Freddie, Fannie, HUD, USDA, Ginnie Mae, all that information we gather, and we're constantly updating, constantly. So for any of you that ever been on my Facebook, my personal Facebook, you see all the information that I put there. Well, on these sites, it's triple that amount of information. And we don't solicit, we don't ask anything for anyone. We're just saying, if you want to get educated, take a few minutes and read. And that's all it does. And it's a really good outlet for an agent to tell their client, you want a little bit more information, take a look read a little bit, or they could take some stuff off the site and send it to their client. It's all public information. It's not proprietary. It's just me grabbing information. Rick, I get a lot of your stuff and a lot of your statistics, and I'm sure you see it.
Yeah.
But that helps me convey the message from the experts to the consumers. I'm just a middleman. I'm the mediator of opportunity, the mediator of home retention. That's all we do. We mediate to give them the best workout solutions. And again, everything is free. I mean, obviously we sell the property, it's a different story, but all the services that we provide are free, not only to the consumers, but as well to lenders and realtors, all of our partners, because we feel that the more individuals that know it and practice it and utilize it are touching the communities and the families who really need it. And that's what we're about. When we say we're homeownership advocates, it's just not a word, we actually mean it.
Great.
Well,
Oh,
Go
go
ahead,
ahead. Andrea. Oh, I was just going to say, unfortunately, we're at the top of the hour. We're at our time. And I wanted to thank you guys. You shared a lot of very helpful information, and each of you have passion about what you do. And I love that. And I thank you for that. And Mandria, you're always a great co-host. So thank you so much for allowing me to participate with you today. I don't think we have any questions. I did want to just remind everyone that AREAA, we're having our annual convention is coming up the first part of October. So if you haven't registered for that, now would be a good time to head over to the AREAA website and book your conference and travel arrangements. We would love to see you there.
And to summarize, thank you all very much. Anybody who's on the session is very lucky to have the expertise of default REO that is in this room, and they may not even have any idea. So again, thank you so much, and we will see all of you very soon. Thanks for joining us.
Thanks, everyone.
Thank you, everyone. Thank you.